Flows are collapsing and markets finally showing some jitters today. So that leads to the obvious question. Is this it? Are we finally in for a top here, or does this market still have a little left in the tank? That's what we will be covering tonight. I will say this. We are absolutely at a bit of an inflection point at this juncture, and I really do think that if there's ever a case to be made for a bit of a pullback here, it is now, and I'll go ahead and make that case. We are now looking at the daily Treasury statement. This is the 90-day average, at least the green line on this chart is the 90-day average of the net flow, so withdrawals minus deposits from the daily Treasury statement. And what you'll see is net flows are really kind of falling off a cliff here. Why? The June tax drain usually happens, I believe, on the 16th. It came out on Monday, and we were down net about $90 billion. So what does that mean? Remember, from this applied MMT framework, when the government spends, that's adding financial assets to the private sector. So when it taxes, that means it's removing financial assets from the private sector, and that has consequences. And that is why historically during major tax drain seasons, and that's going to be your June, your April, well, obviously, no, we pay taxes in April, but there's a big corporate tax drain in June. There's also one that happens in September, and there's also one that happens right at the end of the year and at the beginning of the year. Historically, that is when you see these pockets where markets show the most amount of volatility. And given the dynamics at play and given other variables that tie into it, that is why historically you see those time periods showing volatility. And what I can do is I can actually show this where we average the average daily return 1980 to today, and you can see that heading into the end of June, markets usually have a dipping return year over year when you finally get to the end of June, in part because of that strong tax drain that happens in the middle of June. And each one of these major pauses pretty much aligns with tax drains that happen at that time. And so this is a very important dynamic to know where we are at. Now, one of the things that we also have to understand, and maybe a reason why sometimes the tax drain doesn't line up versus why it does, is where are we at in the overall cycle. If a tax drain happens and markets are already down and we're still in an overall bullish market, that doesn't necessarily mean that a tax drain is really going to push stocks lower. It could just be a brief pause before the larger rally happens. But what I like to do is understand where flows are at relative to the overall sentiment of the market. That's exactly why I built the flow sentiment ratio. And what this is looking at is, okay, where is sentiment at this market? Is it aligned with the underlying structure of what we would expect markets to, or where we would expect market participants to be at, right? So high flows, we should have relatively bullish sentiment, but low flows with bullish sentiment means there's a misalignment with where market sentiment is and with where flows are at. And that's exactly where we are at. In fact, we've really been here going back quite a few months, which is why we saw that brief pause in April. And I now think we're going to repeat similar to what we saw in April. Probably enough, too, to finally knock sentiment down a bit, and that is what I'm expecting here. So enough of a pullback as we head into next week to kind of reset sentiment, get some bearish sentiment back into markets, reset the sentiment, and then have those flows really start to come back on board as we head into July. So that is my expectation. Now the question is, how bad do things get? And this is where I'm going to diverge from the bears. I don't think it's going to get terribly bad. Maybe 5%, probably something similar to what we saw in April. Maybe things get a little more dicey. We are, again, very long in the tooth here in terms of the current rally, but this is far from game over. I've seen a lot of voices on Twitter and in the mainstream pointing to some of the recent macro data, such as retail sales and whatnot, being a little bit weaker than expected. Look, we are far from the better than expected tour that we had in 2023 and early 2024, but this is far from an economy that is anywhere near its end. If anything, I still will make the case that we are at the very early stages still of this expanding economy. So let's shift gears and let me kind of make that case. We are seeing things like loans and leases. This is year over year rate of change, loans and leases starting to really reaccelerate here. And if you turn this on the actual level, we are reaching the highest level that we've ever had in history on loans and leases. So we're starting to see new highs in loans and leases. Same thing with bank credit. really see that bank credit starting to reaccelerate, rate of change year over year higher, and the change in that month over or week over week starting to really accelerate once again. And this makes complete sense from this applied MMT framework. The theory here is that when government spending accelerates, as it did as rates pushed higher in 2022, increasing the interest income that was given to the private sector uses that additional flow as safe assets, as that capital base for the private sector to then leverage up on. So our argument for quite some time, and now the rest of the world is finally realizing this, is that when the government spends, when that spending accelerates, that creates kind of a capital base for the private sector. The private sector then uses that to leverage, and now that is what we are transitioning into, the beginning of a new credit cycle. And this credit cycle has enough to last for quite some time. It will probably be year, 2 years until we reach any real peak to this credit cycle, and it could even push even further than that, certainly given the spending that we've seen over the last 4 or 5 years post-COVID, and then the interest income from the higher rates. I think we're just getting started in the long run, and I, for one, am in no way concerned about the occasional data point now that's going to be dropping that isn't this better than expected that we saw for so long. The reason is a lot of the tools that kind of the mainstream market followers have developed are very attuned and far more influenced by the credit cycle than they are by the fiscal cycle. A lot of that just has to do with the fact that they just don't understand kind of this applied MMT framework, and so a lot of the tools they developed get far more focused on the credit cycle, and so they're able to better predict what is about to happen, and so that's why we get less better than expected, because their tools align more now with kind of the engine that is going to be creating economic growth from this point forward. And so I expect the better than expected train to end, but that doesn't mean that the economy is going to get sour anytime soon. No, we are still very early on in this cycle, and I very much expect to be at this point probably deep into 2025 before it looks like there's any chance of a top. The last thing I want to talk about that aligns this entire picture and shows why this is kind of a bit of a inflection point. So we talked about long term, not all that worried. Yeah, we might see a sell-off here, 5-6%, maybe a little bit more if things get really dicey. But after that dust settles, we will push back into the rally that started all the way back, really at the beginning of 2023, but certainly this last leg at the beginning of November of last year. That'll kick back off after this what will likely be brief pause. But another thing that is really aligning with these flows dropping and with the market kind of making these fresh tops at the end of this week here, the middle of this week, is we are running right into June options expiration. And so why this matters is because as those flows came in May and June and really propelled this market higher, those flows create this dealer hedging environment where it really compresses volatility and leads to this reinforced buying that we've seen, and this kind of rally that we've seen up until this point in June. So even though flows collapsed at the beginning of this week, it takes some time for the underlying market structure that really kind of defines where price is in time at any given point to give way and open the door or open the window for the volatility to come in, right? And that's exactly what we're going to see as we head into next week. We're going to see that period where flows and the underlying dynamic that allows those flows to reinforce price are going to both be giving way at the same time, and that's why this weekend particularly, and as we head into next week, are going to be very important times to watch, because this is exactly where, if volatility catches, where we're just not going to have the underlying flows to resupport the upward trend, and we could see a brief period here of volatility stick because those underlying flows are on the sidelines and there's no dealer hedging that's reinforcing the current price to get at some sort of sticky level like we've seen. So I think we're in for a bit of a pause here. Again, this is not an end of the world pause. Do not listen to the macro bears. We are still very much in the early stages of a very strong bullish market longer term. But in the short run, we are going to see some choppiness here as we enter the end of June. And I would, if we do end up seeing a legitimate washout here on the short run, I would actually be probably looking to the next OPEX period, July 19th, as a potential spot where we could finally see things settle, and would look for a good buy opportunity at that juncture, assuming flows end up catching back up, which I expect them to. All right, that is what we have for tonight, at least with the data. Before I go, if you are new here, make sure you check us out over at appliedmmt.com, especially if you like this sort of analysis and you're an active trader, active investor. You can sign up over there. We have plenty of tools in development and live on the site. And if you are new here, get subscribed, hit that notification bell. And if you found this video particularly helpful, give it a thumbs up on the way out. That is all I have for tonight. So until next time, good trading, and we will talk to you then. Bye-bye.